Okay, so I really only want to talk about just a couple of things tonight because we're pretty much there with the material that we wanted to cover. And it's kind of unfortunate that many of you guys did the tax problem already, and now here I'm going to fill in some gaps that would have been very useful before you did the tax problem. But oh well, I guess that's how it goes sometimes. It always amazes me that in a tax textbook, they don't know how to, in our case, is chapter 10 and 11, they just don't know how to divide these topics up because they're so interrelated, and yet it's too much to fit into one chapter. And so by default, you have to digest some of it before you digest the rest of it. So last week we were thinking about capital gains and what they are in terms of capital assets and the definitions, and then looking at like-kind exchanges and involuntary conversions and how sometimes we may not have to recognize our gains. But this week is really all about how we report the gains that we do have. And so that is really a Schedule D problem. And it is really, it's a little, I don't know if I want to say it this way, but it feels to me a little bit cleaner. It's a little less a whole bunch of things, and it's a matter of just sort of implementing some rules. And so what I have here is these bullets from this packet that I've provided you that really summarizes what is in the first part of chapter 11 of the text, which basically is we're going to net the short-term gains and losses, which those are the capital assets that we have held for 365 days or less. And so they're by nature, the holding period makes them short term. And so if we have a couple that we've had some gains on and a couple that we've had some losses on, we're going to net them against each other. And I sometimes refer to that as netting the gains and losses with the same character together. So we're going to net the shorts against the shorts, which is the first bullet, and then we're going to net the longs against the longs. So if we have some long-term gains and some long-term losses, we're going to net them against each other, or gains of a similar nature against each other to begin with. And then when we're done with that first netting process, if the result of that is a long-term gain and a short-term loss, or a short-term gain and a long-term loss, that is, if the short and the long terms are opposite of each other, then we're going to net them again. If they are the same, then we do not net them against each other. So if we have a $5,000 short-term capital gain and a $6,000 long-term capital gain, they're both gains, and so we can't net them against each other. So we only net them against each other when they're of opposite character. And the reason for that is if we have that $6,000 long-term capital gain and a $5,000 short-term capital gain, the $5,000 short-term capital gain is going to be taxed as ordinary income, and the long-term capital gain is going to be taxed in the preferred capital gains tax rates. And so we can't net things that are of a similar nature against each other. Once we're all done with that, if we have losses on both sides, that is, we have long-term losses and short-term losses, we're going to utilize the short-term capital loss first. And the tax law here says that we can take a $3,000 capital loss in any given tax year. So if I net out and I have a $3,000 short-term capital loss and I have a $3,000 long-term capital loss, I'm going to take a $3,000 deduction on the front of the 1040 for the short-term one, and then I'm going to carry over the long-term capital loss to next year. And that carryover capital loss that we're not able to deduct in the current year is going to retain its character going into the netting process next year. So imagine I had an $18,000 long-term capital loss when I got all done with a particular tax year. I could take 3 in the current year as a deduction on the 1040, but then the $15,000 that remains is going to just sort of start over at the top of the bullets, and it's going to be a $15,000 long-term capital loss that I'm going to try to net in the following tax year. This can mean that if you have a a capital loss of some sort and you don't have anything to put against it, that is, you don't have any gains to use it up over a period of time, you may just use it up at a rate of $3,000 a year for a long time or until it's gone. If you have a $30,000 loss, it literally could take you 10 years to deduct it all if you don't have any other gains to use. So that's just very briefly the netting process. Here's the Schedule D where we report these things. And really what the Schedule D is, it's doing this for us. It's having us put our short-term stuff up here. It's having us put our long-term stuff down here. And then it takes us through the netting process. And I won't talk you through that. One of the things that's this table right here is kind of useful because we keep saying, or I keep saying, that these capital gains enjoy this preferred capital gains tax rate. And so we have on the inside flap of our book, we have those tax brackets that we referenced the very first day of the term, where they were 10% and 15% and 25 and 28 and 33 and 35 and 39.6, and they were just different brackets. And so what happens here is that's your ordinary income tax bracket, which is this first little I guess, row in this table that we're looking at. And that is going to be our W-2 wages that are taxed at that rate, and then also our short-term transactions will be taxed at that rate. And then we have these other rates, and I'm going to drop all the way to the bottom, which is the long-term capital gains rates, which are going to be either 0 or 15%. So if I am in the 10 or the 15% tax bracket, then my long-term capital gains will probably be taxed at 0. If I am in the 25% tax bracket or any of the higher tax brackets, my long-term capital gains will be taxed at 15%. So when we say there's this preferred tax treatment, that's like we're speaking literally that we're going to give you a better tax rate for capital than we are going to give you for, say, wages or earned income. This has been, this is a source of controversy sometimes when people talk about economic and political policy. The thought has been in the past that we wanted to give people a tax break for bringing capital to the market, because capital in the market is essential for business formation, and when you form businesses, eventually that's supposed to lead to employment and help wage earners. There have been a lot of tax policy debates over the years about whether or not that actually works or whether or not we should do that. I'll let you do your own research on that. A couple of things that are sort of anomalies here in the middle of the table, and one of those is collectibles. And so on collectibles, we do not give you the preferred capital gains tax rate. We give you this 28% rate. And the reason why we do that is because these collectibles are thought to be things that you are not purely investing in for a money-making purpose, but you are actually getting some personal gratification also. And so this might be if you're a baseball card collector, or if you're you collect stamps, or you have antique cars, or maybe you're just collecting antiques and you buy, I don't know, you buy your favorite trading card person for $100, and then 5 years later you sell it for $175. Well, that meets the definition of a capital asset, and you have a $75 capital gain, but we're not going to give you the 15% or 0% rate on that, because we assume that you pulled out that card on a weekly basis and you looked at it and you were all warm and fuzzy in the inside. And because you got that personal enjoyment out of that investment, in addition to it just being an investment, we're going to clip you for the 28% tax rate. The unrecaptured 25% group is an anomaly that I don't want to burden you with, really, but a long time ago there was some aggressive depreciation that was allowed on real estate, and the 25% rate comes up when you have unrecaptured depreciation from real estate that results in a gain. So that is what we mean by the preferred capital gains tax rates, and then also what we mean by the netting process. Since you've kind of already done this, I think I'll spare you the jumping through the problems here, but this is kind of a fun little worksheet, because you can see here's two short-term ones, so we would put the 5 and the 7 here, and we'd be -2. And then here's two long-term ones, we'd put the 14 and the 21 there, which would be +7. -2 and +7 would leave us +5, and that would be a long-term +5, so it would be taxed at 15% or 0. And you can create these problems in all kinds of shapes and scenarios and different ways of thinking about them. Let me just scroll through here and see if there's something related to 1231 assets. I don't think there is, so I'm going to draw your attention to the text. And on 1119, they begin to talk about depreciation recapture, and on 1120, they talk about section 1231 issues. And I don't think we need to get every single detail of this right, but I want to try to help you understand conceptually what's happening here. So we know that depreciable assets are one of the few things that are not capital assets. There was that definition of capital assets last week, and it was basically everything except for, and then the things that it wasn't was accounts receivable and government publications and certain copyrights and those kinds of things. And then one of the other things that a capital asset is not is depreciable property used in a trade or business. So these depreciable assets, let's just take an office computer. That feels like a capital asset, and eventually it's going to kind of act like a capital asset, but we refer to it as a 1231 asset because a weird thing happens here. If I'm going to spend $1,000 on a computer, so I'm going to buy a $1,000 computer for my business, and I'm going to subject it to Section 179 immediate deduction, or if it happens to be a year where I'm allowed bonus depreciation, I could use bonus depreciation, but I'm going to wipe it off my books, $1,000, by just taking a $1,000 tax expense or a $1,000 tax deduction, which is going to make my basis in that computer in my business 0 because I've fully deducted it. And let's say after a year, I sell that computer for $200. Well, I have a $200 gain now, or I have a $2,000 profit, or I'm $200 ahead because last year I got this great big depreciation, or I got this depreciation deduction, which was a normal deduction. And so what I have to do with that asset then is I have to look at that asset and see if I've taken depreciation against it. In this case, I have. And if so, then I need to recapture that depreciation, and it's going to be taxed as ordinary income. So it's going to be taxed at my regular marginal tax rate. Now, that is a 1231 depreciation recapture. Now I'm going to use the same $1,000 computer, but let's say that I just subject it to makers and it's the half-year convention, and just for whatever reason, I'm going to make up the depreciation and say the depreciation is $200. That makes my basis of the computer on my books $800 because I paid $1,000 and I've taken $200 worth of depreciation. And so now if I sell that computer, which would normally be 5-year property for depreciation, if I sell it for $400, because my basis was $800 and I sold it for $400, I have a $400 loss. That represents depreciation that I should have been able to take, and so that becomes an ordinary deduction. So if I'm a Schedule C person, now all of a sudden I've basically kind of pulled forward my depreciation and I get to take it immediately because I sold it for less than my basis, and rather than being a capital loss, it becomes an ordinary loss. So I've got this one situation where I have a low basis because of depreciation and I sell it and I might have recapture. And then I have another situation where I have a relatively high basis because I haven't been very aggressive with my depreciation and I sell it for a loss, and it can create an ordinary deduction for me. I want to take a different scenario. Let's say I buy this, well, it's hard to do with a computer, but you've just got to imagine that my computer is going to increase in value. So I take this, I buy this $1,000 computer, I fully depreciate it under Section 179, making my basis zero, and then for whatever reason, it's a very special computer, I'm able to sell it for $1,200. I'm going to recapture as ordinary income the $1,000 deduction that I took that was an ordinary deduction. But the $200 above the $1,000 is going to be what we refer to as a 1231 gain. And absent any other weird exception, that 1231 gain, it is possible that it can turn into a long-term capital gain. It doesn't, this is kind of weird language, it doesn't actually turn into a long-term capital gain, but it's a 1231 gain that is treated as a long-term capital gain. And so there is like a couple pages in the text where they try to discuss this idea of depreciation recapture when we need to do that, ordinary loss when we haven't taken enough depreciation, and then the turning of a 1231 gain into a long-term capital gain. That is all figured out and reported on the Form 4797, which this is a little bit of a challenge for us. We did a week job of covering depreciation. That was one of the weeks where I was not really available. And so if that seems all a little bit fuzzy to you, it probably should. It's a little bit beyond what we need to cover here, but because it was in the reading, I wanted to try to give you at least conceptually what was happening there. I think the thing to remember is that, oh, depreciable property used in a trade or business, that's not a capital asset. It doesn't behave the same way. However, there are cases where it interfaces with capital gains and losses depending upon where we're at with the depreciation. So again, one last thing, flipping through the chapter to 1129, installment sales. And I think this is in the packet somewhere here. Here's some basis questions, small business stocks. All of this stuff can get more complicated than even how we've presented it. Remember, the tax code is 4 million words, and you can do a master's degree just in tax if you are nerdy enough to want to do that. I'm making fun of myself there. Well, please stand by. Your call is important to us. It will be taken in the next, never mind. So I thought there would be a thing down here. There's the sale of business property. Here we go, installment sales. And so you may find this page a little bit useful. I kind of like these summaries a little better sometimes than I do the text because I guess less words is sometimes better, I guess. So let's see. How do I want to describe this? In the tax code, one of the things that we have tried to do, or one of the concepts that underlies the tax code, is we generally want people to pay the tax when they have access to the money. And this is one of the reasons why we had the non-recognition rules before with involuntary conversions. That was like, you suffered from a hurricane, or eminent domain took your property and you got an insurance proceeds sale. and that sort of forced you into a gain. But you're not really economically better off, because if you want to put yourself back in that same position, you have to spend all the cash to put yourself back in that position, at which point then you no longer have the cash available to you to pay the tax. And so this idea of trying to collect the tax, when the taxpayer has the cash, also drives this idea with installment sales, where basically if I sell an asset, a capital asset, at a gain to somebody, but I disperse my payments over time, then I'm going to disperse my gain over time also. So let's say I have an asset that I have I'm going to keep the math really simple here, that I have a $6,000 basis in, and I'm going to sell it for $10,000. That would normally kind of create a $4,000 gain. But instead of accepting that $10,000 all up front, I'm going to accept it as $1,000 a year for 10 years. What's going to happen in that situation is each year when I get that $1,000, $600 of it is going to be a return of my basis, which is going to be tax-free. But the $400 is going to represent the capital gain. And so I'm going to have $400 in capital gain each year for 10 years because I did an installment sale or a contract sale, and I spread the cash receipt over many years. And if I do my paperwork right and I handle things correctly, that will allow me to spread the gain over 10 years. And so this is not something that you see happening very often. It used to sometimes happen with land sales contracts on real estate. It would occasionally happen with other types of property. But I just want you to be aware that that's one of the closing items in Chapter 11, and it is also here in this packet for you to consider. So those are really the only things that I wanted to jump into tonight. That's a very rapid fire overview of the chapter, which is really the netting process, the 1231 issues, and then the installment sales issues. And then I thought I would jump from that to, let me see if I can make this work. Here is the Lilly Sago, whoops. Here is a spreadsheet representation of the Lilly Sago problem. And there were a couple of things that kind of drove people a little bit nuts here, and that's kind of to be expected. We kind of had the problem before the chapter, cart before the horse kind of problem, and so this is an attempt to try to just clarify a few things here. This is Lily's W-2 wages, and then the $250 bank interest, the $600 in dividends, and or $1,600 in dividends, and $1,000 in capital gains. She had $8,000 to the positive on long term, $3,000 to the negative, which makes that number $5,000 to the positive. And then when I net the 5 against the 4, that's where that $1,000 comes from. So that was, that was like a shell game. I did all that really fast, but that's that would all play out on your Schedule D, but that's the $1,000 in long-term capital gain. Now, that makes her AGI here. I have that number duplicated, but there's her AGI. So these qualified dividends and these capital gains, they go into the calculation of AGI, which is kind of important because remember, some things depend on our AGI. A couple of the easier ones, or one of the easier ones, I'll give you two. Our medical deductions on our Schedule A are only deductible to the extent that they exceed a certain percentage of AGI. So there's why AGI is important. Another reason why AGI is important, we saw with the active participant rules in real estate that if my AGI was less than $100,000, I could deduct $25,000 in passive real estate losses in the current period because my AGI was moderate enough to allow that to happen. So we must put our capital gains into the AGI calculation. But then it gets weird. We're taking away the standard deduction here and the exemption, so that gets us to the 8505 in taxable income. And now I'm going to, and I don't know, I'm gonna use a big word here, and I apologize for that. I'm gonna bifurcate the income. That is, I'm going to take away the things that are taxed at a preferred rate. In this case, it's the $13.50 in qualified dividends and the $1,000 in long-term capital gain, which is $23.50. So what I've done here is I've subtracted the $23.50. Then that leaves me with taxable income of $82,700. And I'm going to use that as the number I look up in the text to figure out the tax. And then once I figure out that tax, because if I look on the inside flap of my book, I can see that Lily is single, and if she has $82,000 in income, she's in the 25% bracket. So that means her preferred stuff, this $23.50, is going to be taxed at 15%. So I look up the tax on the $82,700, and then I tax the $23.50 at 15%. You can see in my formula here that that's the $23.50 at 15%. And then I put them back together to get the tax. So it's kind of like I put all the income together to get AGI, and then to get all the way down to taxable income, and then I split the preferred apart from the other income. I tax each of them. I tax the ordinary income, and then I tax the preferred stuff, and then I put the tax back together. The Schedule D worksheet does this for you. Permission to speak freely? Anybody?
Yeah.
Okay, the Schedule D worksheet sucks. It's like impossible to see that that's what they're trying to lead you through as you go through that worksheet. I think only one of you got there. You know, a bunch of people had like almost everything else right on the tax problem, but they couldn't get through that Schedule D worksheet. I oftentimes encourage people not even to do the Schedule D worksheet. You know, if you're a professional tax preparer, what happens is you have tax software that helps you. It's literally almost easier to put all of your income into the 1040, drive all the way down to taxable income, and then just get out a piece of paper and write down your taxable income, and then like draw two arrows, one to each side of the page, and put your ordinary part on one side, and then put your preferred on the other side, calculate the tax on the two things separately, and then add the two taxes back together. And you can see here, that's what I've done. I've taken the 1640, which is the regular tax, the 16420, and then I've calculated the tax on the qualified dividends and the long-term capital gains, and then I've added them back together. Then there's the withholding, and then that gets you to the refund. So I wanted to at least talk you through what that Schedule D worksheet is trying to do for you. And if you thought that it was really your enemy, you were not wrong. It really is just an incredibly poorly designed worksheet. They literally should almost do it like I described it, where you like put in the total taxable income at the top, and then create two columns, a left and a right-hand column, and put the ordinary stuff in one column and the preferred stuff in another column. Calculate the tax on each, and then at the bottom of the page, combine them back together. Because once you visually see, or once you understand what's happening there, it's not an incredibly difficult process, but the instructions on that worksheet are just mind-boggling. So with that, that's all I want to add about capital dividend or capital gains and taxes. You guys are probably like, I just want to know what I have to do on the final so that I can be done with this mess. And so I will take us to that now. Here is the final exam. I published it 30 minutes before we started here, so it is available and ready now. It is 100 points. There is no time limit. It's been a challenging term for you guys, and so in the interest of trying to help people score well, no time limit. So you can take as long as you would like, although I'm sure you have other finals, other things that you might want to do. We'll preview it here. There are 23 total questions. There are these two short essay questions, definition of a capital asset and why you prefer capital gains. That should be fairly good after tonight. and then a more general question about what is tax planning and describing some strategies and some examples. And then after that, we get into 21 true, false, multiple choice kinds of questions. And again, no time limit. You will find that they do relate more to the last couple chapters that we've done. And so you may want to focus on the last few chapters. Actually, they literally are all from the real estate chapter and the last two chapters that we've done. So if that helps you narrow your preparation, hopefully that will help. I know it's hard to look at while I'm scrolling through it there, but I didn't want to give you every question. I mostly just wanted you to know what to expect in terms of the structure and the format so that you could prepare well. That's all I wanted to say for tonight. So capital gains, we're going to net the shorts against the shorts, the long against the longs. If they're opposite, we can continue netting. If they are no longer the opposites, we're done netting. We're going to take the short-term losses first. If we're limited in only taking $3,000 a year, we'll carry over the long terms if necessary. And then we did a little discussion of 1231 assets and a little discussion of installment sales, and then a brief highlight of the final. I thank you all for your patience and your participation this term. I have not been able to maintain the standards that I usually like to have, but I certainly did enjoy interacting with all of you, and I wish you well with the final. I will be available by electronic communications. You know, you can send me a message here in Canvas and I will watch those daily. But I think really at this point, all you need to do is finish the final. In the event that the final scores are, I tell you what we're going to do, whatever the high score is for the final, I'll add enough points to make the high score 100. So just like we did with the midterm, if the high score for the people who take the final is 94, then I'll add 6 and everybody will get those 6. So we'll drive both that second midterm and this final, the overall scores up a little bit to help the curve. And I would say that if you have scores for all of the tax problems and for the 2 midterms in the final, I don't believe you have anything to worry about in terms of an overall grade. So thank you very much for your effort and for the opportunity to have spent this time with you. And I wish you a great deal of success as you wrap up the term. Any final questions or anything I can do for you guys?